Studying how people behave can be the key to unlocking what they truly want and how they feel, and this is closely linked to our biases. But what exactly are consumer biases, and how are they relevant to banking?
For a couple of years, I've been very passionate about studying this phenomenon, this psychology, the human psychology, because actually consumer biases are human decision-making errors in purchasing context. So we're doing the same errors as as consumers, both as humans, decision-making errors. Um, Basically, this is related to the fact that surprise, we're not robots. Okay, so we have feelings. We tend to believe most of the time that we are most of the time rational, and we think deeply, but it's not happening all most of the time. So because we can't really separate our emotions for our decisions in financial industry, it happens the same in the financial products. And if we're thinking about being fully rational and fully data driven, I think that's only for AI and for robots. And what I've seen is also, despite good intentions, actually, and again, you can analyze that, and this is how I started, by analyzing myself in a normal or other context. Despite all our good intentions, we often make less than optimal financial choices. And I have some examples for you if you'd like to. This comes in various reasons most of the time, because we have a lot of things on our mind, and it's not really the most important thing to understand a financial product. And there's another thing that I'm trying to build inside our organization at the moment, is that customers have actually goals and needs, desires. They don't actually, and they want to fulfill them with different solutions. They don't actually start from thinking, they don't start thinking from a financial product to the goal, but rather the goal, and then they find that some of the solutions are related to financial products. And yes, I have some examples of how we're not very rational when we're doing decisions. The best ones are related to savings, and I think they're very common to most of us. And for example, it's a bias that people it's called present bias, or they prioritize today over tomorrow. And what this means is that we, because we do that sometimes, we prioritize today's needs and desires over tomorrow's. And this means that we although we know that tomorrow is better to save for tomorrow, we don't do that. And that's because it seems that's an effort. And most of the time, it's because we have difficulty in visualizing the future. There's been tests and studies that when you show a picture, when a bank, for example, shows a picture of yourself the retirement, that the chances are for you to save more for a long time. There's been studies doing that. So the idea that we can't really visualize all the time for long-term investment, it's not doing us very good. And there's another thing, that we prefer, of course, the satisfaction at the moment rather than the future savings, even though we know that it's better for us to save for the future. Another thing that, or in another product that we're looking at to see how customers are influenced by this biases and these errors, is insurances. We also have insurances that we sell, also in related to loans. So I think there's an interesting, we really had this, I don't call it experiment because we put it in production. So it was really interesting because we only, we position or we sell an insurance, an income insurance policy when you get a loan digitally, fully digital. So what we've done is, and when you get this insurance, then you get also a discount in the interest rate of the loan. So customers haven't been that willing to take this insurance, although it's important, especially for these days, this income protection insurance. So what we've been trying is actually change the way the customer take the decision, the buttons. And we said, instead of I don't want this insurance, then we changed it to I don't want this insurance and I'm okay to lose those 0.5% of the interest. We actually changed only the text, and we've been doing that because we know that people are loss averse, so they hate losing an amount. Rather, they hate more losing an amount rather than they're happy winning or getting the same amount. So basically, we try to show them that they're losing this 0.5, I don't know, 1%, whatever it is, that they can get if they're not getting this insurance. And actually, we've seen increases like from with I think, let me just calculate from my mind, but it was like 20-30% increase in the total acceptance of taking that insurance. And this was a great use case internally to show that actually this focus on behavioral science and understanding how customers take decisions, it's good, and especially in financial institution is good if you're trying, again, but this is really important, if you're trying to improve the customer's well-being and financial health, so with the product. So if this is the objective, then I think that's really important to have this skill in the organization, because this very small changes can have a huge impact in customers' well-being in the end. So we have more customers who are protected against any problems that they have with their salaries.